So in the run-up to Jeremy Hunt's autumn budget last month, there was a lot of talk about big changes being made to inheritance tax. It was even suggested that it might be scrapped altogether. But, well, it didn't happen, mainly because it was seen as too much of a giveaway to the already well-off. There are, after all, only 4 to 6% of estates affected by inheritance tax. But it does remain Britain's most hated tax. Even though relatively few people pay it, there's an ideological resentment to the idea that you generally pay tax your whole life in some way, shape or form, and then the taxman helps himself to a bit more when you're dead.
Excellent.
I have talked previously about various ways you can alleviate inheritance tax, or perhaps even mitigate it altogether on this channel. To be honest though, all of those methods are either quite complex, such as using trusts, and/or they carry a price tag. So what if there was a way of reducing your IHT bill without the need for any of those things? A way of passing on however much you want to whoever you choose without restriction, in a way that sees the gift leave your estate immediately. Would you want to know more about it?
Yes! Hell yeah! Hey, come on, baby!
Well, it may surprise you to learn that such an option does exist, and it doesn't require the use of complex or expensive arrangements. It's called the Gifts Out of Surplus Income Exemption. Many people haven't even heard of this valuable allowance, but it can be extremely powerful in reducing the taxable value of an estate. There are specific rules that need to be adhered to though, and actions that you need to take to ensure you qualify for the exemption. I'm going to explain exactly how and what you need to do in this video. I'll also show you the sort of impact that this planning can have over the course of your lifetime. If you've landed here for the first time, by the way, I'm Chris Bourne, and for the past 20 years, I've been helping people achieve tax-efficient financial independence. And this channel is where I share my knowledge with you to help you make better informed decisions. Don't forget to subscribe if that's the sort of content you're interested in. Turn on the notification bell, and without further ado, let's get into it. So the first question that needs to be answered to ensure you can qualify for this exemption is, do you have surplus income? This doesn't cover making gifts out of capital that you've accumulated. And just so you know, excess income that is saved starts to be treated as capital if you don't give it away within 2 years. If you're somebody who doesn't receive income, or at least surplus amounts of it anymore, and you now rely upon drawing down on capital that you've amassed, this exemption may not be available to you. And the other videos I've linked in the description below might be more applicable. Having said that, there are potentially still ways you can qualify, depending on how your investments are structured. Income can come in many forms. Surpluses from employment or self-employment are the obvious ones. Rental income, pension income from annuities or scheme pensions are others. But natural yields from investments, such as interest and dividends, all count towards what's considered income. So if your portfolio is invested in a way that targets capital growth by using accumulation units, you could instead structure your portfolio to prioritise investments that throw off an income instead. Certainly one of the benefits of the higher interest rate environment we currently find ourselves in is that it is easier to generate income, even from lower risk investments. The second thing you need to ensure is that the gifts you're making are regular ones. The exemption won't stand up if you just make sporadic payments that don't follow a regular pattern. They're likely to just be viewed as potentially exempt transfers and be subject to the 7-year rule, which means the gift will still form part of your estate for 7 years after you make it. Regular though doesn't mean it has to be every month. It can be less frequent than that, such as quarterly, half yearly, but probably at least annually, as long as it follows a regular pattern. And the final criteria that has to be met is that the gift can't affect your everyday standard of living. If you're the type of person who usually enjoys spending their winter months skiing in Courchevel and your summer months soaking up rays on a yacht in the Med, then you all of a sudden revert to taking a wet and windy week in Rhyl out of season, HMRC are likely to see through it. Even if you have a less extravagant lifestyle but suddenly take various cost-cutting measures in order to make the regular gifts, this probably won't work. The exemption is really for people who find their bank balance creeping up every month because they just don't need what's coming in. The beauty of this though is that there really is no upper limit. You could literally give away a couple of £100,000 a year if your income was high enough, and it would exit your estate immediately. But to a greater or lesser extent, many people can benefit from this exemption, and most aren't aware of it. Providing these conditions can be met then, what are the essential things you need to do to ensure your estate fully benefits from the exemption? Well, first, you need to record your intention to make regular gifts. This doesn't need to be in the form of any specific legal document though. It can just be a letter that you send to the recipient stating that you plan to make regular gifts to them out of excess income you don't need for yourself. It would also be wise to keep a copy of this filed with your will. One thing to note is that the gifts don't all have to be of the same amount. They just have to follow the same methodology. You could, for example, say that you want to give away your excess dividend income or your excess bonus. Those things can fluctuate, of course, but just put as much detail as possible in your stated intentions to remove any possibility of the gifts being challenged. Another very sensible thing to do to ensure the success of this strategy would be to keep very good records of your income and outgoings. And once again, to keep these annual records filed with your will. You could do that in any format you choose, of course, but I'd suggest actually using the IHT 403 form, which is what your executors would have to fill out anyway. So this would save them a big job. The form is used to record all gifts, transfers and settlements that an individual has made up to 14 years before their date of death. But the last page of the form is specifically for recording details of gifts out of normal income. So because your executors would have to fill this in anyway, it makes sense to record everything there in the first place. If you're concerned about gifting too much to someone who you feel may not be quite ready for it yet, you can always pay the gifts into a trust and distribute them later. Your intention, after all, is probably to help little Johnny onto the property ladder, rather than see him splash it all on some old school style blowout on his 18th birthday.
We're going streaking through the quad and into the gymnasium. Come on, everybody!
As a reminder, if you do wish to learn more about different types of trusts and how they work, check out the video I've linked in the description below. Just tap where it says more under the video title and you'll find it there. Just fair warning though, trusts are a bit more complex, so there's quite a lot of info to take in. But assuming you're able to meet all of the criteria, what kind of impact can it make to your future legacy position? Well, I've taken a real client of mine here, changing just the names to protect the innocent, who we can see from the planned legacy section of VOYANT has a projected future IHT liability of over £2.4 million. Now this is someone with a large amount of excess income, which will continue well into retirement. But to make things a little more realistic to a larger number of viewers, I've created a what-if scenario that assumes he gifts £5,000 a year, increasing by inflation every year for the next 20 years. This is in addition to the annual gift exemption that he's already using. Taking that action is enough to reduce his projected tax bill by over £130,000 over the course of his lifetime, which is a significant amount. And we mustn't forget that the person receiving the gift is likely to be someone who already stands to benefit from the will. But by using this exemption, he's able to see the individual benefit while he's alive, rather than after he's gone. And a lot of tax has been saved for the recipient. Remember, you can access this fantastic software yourself and all of its capabilities for your financial planning and tax planning through my VOYANT masterclasses, also linked in the description below. Having access to the right tools really is a game changer. Guys, the next video I'd recommend you to watch on the subject of inheritance tax planning is on screen for you now. Be sure to check that out if this is an area you're interested in. And as always, I hope that's been helpful. I'll see you next time.